Hello and welcome to the latest update. This is for the month of March with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. Hi again.
Lovely to have you with us. So if we look at what's happened at the markets in March, generally most of the investment funds that we recommend have seen a positive return, which is quite good because prior to that, as you know, we had 2 months of negative returns, and we're starting to see, I think, markets realizing that inflation is going to be with us for a good while and then acting accordingly. And also the banks' interest rates are going to be going up through the central banks, and what that then means for the world at large. The bottom line is that we've still got too much demand and not enough supply, and this continues to worry just about every sector that we have, with prices increasing, some very, very rapidly, such as wheat, for example, up 50% in price over the last 1 year. Fuel, whether it's for household fuel, gas, electricity, and petrol and diesel. So all these are out to a backdrop of high inflation, which is likely to remain for a good wee while, and also supply shortages issues. And in the labour markets, full employment almost in the UK, record employment here, and the lowest jobless claims in America since 1969. So generally the world is doing very, very well, probably too well actually, because we've got too much money, and that's causing the inflation pressure. Looking at the biggest performer this month in terms of the percentage gain was America, North America in particular. So it's a very good time. A lot of the tech stocks bouncing back after their recent poor performance in February and January. So tech's back. Certain tech stock is still suffering, but it was a bounce from the North American market. The UK, smaller companies still suffering a little bit. The bigger companies are doing reasonably well, and that probably is going to continue to be the case for a good while now. Europe was fairly flat, as was the Far East. Still issues with China and lockdown, zero COVID policy, economic conditions over there, so that's causing a wee bit of a difficulty for the market. And we've got the challenge from the property market in China continuing to bring distress to that side of the economy. The other bright spot was worldwide property. That had a really good month in March, price up considerably. And I think it just shows that if you've got quality in your portfolio, whether that's hotels, resident shopping, etc., then you've got a good chance of making a decent return. It's location. The laggards, the funds that are not doing well, and I think if you've watched this presentation over the last 2 years, it's the same things. Fixed interest. So lending money to companies, lending money to governments, negative returns from just about every fixed interest fund in the UK. An area that we've been really sort of hammering for the last wee while now is to review portfolios. Anybody with cash, anybody with a high fixed interest component, that is where the risk is at the moment. With inflation running at record levels, then fixed interest is something that we want to be very, very wary about.
Fingers crossed we've turned the corner then, Andrew, hopefully, for the first couple of months, and now we've seen a positive month, which is good news for everyone involved.
Yeah, I think it's markets getting used to the conditions, and now that they realise inflation is not transitory, it is going to run for a good while. But generally, the conditions are very, very good around the world in terms of economic growth.
And now we'll have a look at the portfolios and their performance over the last month, year, and 5 years, Andrew.
Okay, So starting with the cautious portfolio, this month has grown by 0.96 of 1%. Over a year, we're up 1.59%, and 5 years up 25.8%. The balanced portfolio, which is higher exposure to equities, that's up 1.78% this month, 3.06% over the year, and 37.02% over that 5-year period. Capital growth, around about 83% equity exposure. Over the 1 month, 2.42% positive growth. Over a year, 4.66%. And the 5-year period, 48.35%. And finally, our aggressive portfolio, around about 92% equity. Over the 1 month, 3.2% positive return. Over the year, 6.84%. And finally, the 5-year period, 60.81%.